5 years and business is successful and you're going out into the marketplace trying to raise kind of $3 million or whatever to take that business now on a journey to a whole nother level. Now there's not really as much risk. Maybe now you can approach investors. You don't even have to give up any equity. You're just like, look, man, we just want to borrow money. We'll just pay you some interest over the next 3 years. And then boom, we'll do something. We'll, refinance, or we'll have some type of an event in the business's growth, and we'll be able to give you all your principal back. Or again, it will convert to equity, but based on certain triggers that take place in the business. We go out and have the business valued, or go out and look at our revenues. And once we hit those benchmarks, you'll be rewarded.
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9 figure businesses. We interview top level 8 and 9 figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9 figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. Now, most of you guys are going out there and scaling and growing your businesses. However, though, sometimes you have too much of a month and you don't have enough money. And you're sitting there going, okay, we want to raise capital. How do we do it? Where are the investors? What's going on? What's the proper way? How do we make sure we do it legally? And all sorts of ins and outs of things. Now, we have this next guest on, and we're so excited. We're thrilled. He is called the $2 billion man. Yes, that is a B with a billion, my friends. The reason why is because he was able to raise incredible capital in this regard. He's raised so much capital in so many different arenas and so many different industries. And we're going to be diving into that, exactly how to do that, what to focus on, and where to focus on your time and energy. Now, he has been globally recognized, and he's been a national speaker. He is an author. He has been nationally recognized and published in so many different NBC, ABC, all those things. He's shared numerous stages with very high caliber people. He runs a Capital Con 2022, which is an incredible conference, and then as well as a boot camp diving deep into like the know-how and what, and the focus on all the intricate details. So please welcome my next guest, the one and only Sir Brad Blazer. How you doing today, Sir Brad?
Hey, I'm doing great, Christian, man. It's great to be here with you today. Always great to be on shows and just, share my vision, kind of share my journey and kind of share my story. So just real blessed to be here with you today.
Well, hey, man, I'm excited about this as well because, I was looking at your bio a little bit, and it was actually interesting because, see, the company that you were working with, the founder, the oil and the gas industry, everything basically got just pulled out from underneath you. Collapsing oil prices, the Tax Reform Act, but you did not slow down. And you went out there and just pivoted very quickly and started on this next journey, which is what you're known for, which is raising capital. So kind of help me unpack that a little bit. What made you decide, oh, this is the answer. This is the solution. This is the channel that I need to really focus on to help our business?
It's funny. I remember when I was a little kid, I was about 7, 8 years old. And kind of like Robert Kiyosaki, man, I had a rich uncle, kind of the rich dad, poor dad, right? I had a rich uncle in my life, and his name was Uncle Henry. And I remember walking around the Palm Beach Country Club one year after dinner. And, it's kind of funny. He'd point over to people, say, see that guy over there? And I'm like, yes, Uncle Henry. He makes all the erasers at the end of your pencils you use in school. What do you think about that? Or this guy over here makes all the hangers hanging in your closet. But he put his hand on my shoulder and he said something to me that I still remember to this day. It was, if you can figure out, Brad, what you're really, really great at someday and create some content around it and deliver it to the world, it'll be magical for the people it helps, but more importantly for you. And in life, they call that a revelation. It's like a major aha moment. But the funny thing is, when I was 7, I had no idea what that was, but it stuck with me because I was very impressionable and I really looked up to this man. And so, I kind of went through life and, when I was growing up, I always wanted to be an architect. I was great at designing things. And then responded to an ad in the in the newspaper when I was in my early 20s. and got sidetracked and ended up in the oil and gas business. Went to work for one company. They taught me how to get on the phone, call out to high net worth, rich people, build trust. Started raising money for them. And then I went to work, started raising money for a second company doing the same thing. But it turns out the guys running that second company were just a bunch of crooks. And so I resigned, and all the investors that I had worked with brought together, looked at me. They had no idea I was a little 23-year-old kid, because we didn't have internet back then. I was doing all this crap over the phone. They're like, well, what are you going to do now? I'm like, I don't know. Why don't you do the same thing, but just do it honestly? And so I saw this huge opportunity in my life. Didn't know the first thing about drilling for oil wells, didn't know anything about starting or building a business. I just knew how to get on the phone and talk to people. So I printed some business cards, launched an oil company, and literally, Christian, over 10 years, man, had this very successful business, raising money, teaching other people how to do it, drilling for oil in Texas, Oklahoma, Louisiana. And then, kind of like you said, in the late 80s, early 90s, two big things changed: collapsing energy prices, changing tax laws. And so I went back to school, finished my degree, and came out. And I was actually watching a TV show one day, and it was Steve Harvey, and he was there on stage, and he said, it's my belief that everybody in my audience has something special. It's what I call your unique talent. But most people will never figure out what that is. He said, that's why we have so much discontent and happiness. People go to work and they're looking for another job within a matter of months because they hate what they do. But if you can find it, he said, it's magical. And I'll never forget, it was about a week later. I was on my back patio. I was drinking a scotch, smoking a cigar, which I like to do in my backyard. And it hit me like a ton of bricks. And it was kind of like that revelation. I said, oh my God, like what I know how to do better than anybody I've ever met is raise money. I've raised millions. And I realized that that was the big problem that most entrepreneurs and business owners face. You see, everybody I believe in the world has a dream and a desire to do something bigger in life. So we all do. But the reason we ain't, quote, doing that something big is not because we're scared to do it. It's because we just lack the money to even get started. So if I can be the catalyst that teaches people how to attract and raise capital, Christian, I can help make a lot of people's dreams become reality. And that's what we do.
Well, what I find so interesting about raising capital, I've had a lot of conversation in regards to like my personal equity stuff, and then as well as other investors I've talked to, and there's a lot of things that go in that. Now, one, obviously, a lot of people always ask, like, where do I start? But beyond that, a little bit even further, it's obviously the intricate legal documents, the proper equity position, obviously the debt, and the structuring of the conversation a little bit. In one of your interviews, you talk about the power of relationship and trust more so than anything else. And I would just kind of love to first walk through that, build that base a little bit, and why that's so important compared to, hey, does this person have 250? Maybe you don't jive, but they have 250. Maybe they have $500,000. They can write a $500,000 check. Cool, wonderful. It solves a problem, but you don't jive on a relational aspect and the importance of that.
Yeah. Here's the big thing. I think this is just common sense, but it's something that most people overlook. Nobody, and I mean nobody, is going to write you a check until they trust you. But here's the thing. Trust does not happen overnight. It's kind of like dating, right? And the women get this a lot better than the guys do. But the funny thing is trust takes time. And the biggest mistake most people make when they try to raise capital is they have a deal, or they have a business, or they have an opportunity. They are approaching somebody that they know has money, and they start pitching or talking about the opportunity to invest way too prematurely in the process. But out of respect for you, that person says, yeah, Christian, send the stuff over, man, I'll take a look at it, which you do. But then when you try to follow up and close them, man, they are so non-committal and they're so evasive. They give you every damn excuse that we've ever heard as to why they don't want to invest. And it's not that it's a bad deal. It's just they don't trust you. So what I mentor people on is slow down, man. You'll get to the pitch, but slow down and spend time really getting to know that person. But more importantly, giving them a chance to know you, so that when it is the right time, they're willing to move forward in that process with you. You see, I talk about things that are universal key concepts when it comes to raising money. That's why we coach people around the world in about 10 countries today. So it not only works here, it works in Canada, It works in England. It works in Australia. It works in Brazil. Hell, it will work anywhere. I mean, if they had, people on Mars raising money, I'd be beaming up my coaching program to them. But the funny thing is, there's something that I talk about called the 4-step blueprint. Think about raising money as 4 steps, just like a quarterback moving the ball to the end zone. There's 4 downs. There's an introductory call, there is a follow-up call, then there's a pitch, and then there's the close. The first 2 calls, man, it's all about them. And there's something else I talk about called the trust sequence, which is 6 steps to build trust in another person. It all starts with their perception of you. What do they think when they meet you? Then you're going to ask them a whole bunch of questions, because it's been psychologically proven. If you can get people to open up and talk about them, they will feel a connection. And then you basically get to that connection part. You start to sense, man, this person likes me. He's responding to my emails. He's answering the phone when I call him. And then you ask a very important question in what we call the raising capital business. We call it the validation phrase. You need to validate that person trusts you enough to move forward in the process. Otherwise, you're just wasting your time talking to them. And I can't tell you how many hundreds of people will have unproductive conversations with people where they're just like a damn hamster on a treadmill, and they never get to yes, or they never convert to the person writing a check. And it's because they haven't asked that simple question. Once you get a yes and you get a green light, you can now pitch, because that person's opened the door to you basically presenting an opportunity. And then hopefully the next time you talk, you're closing and you're picking up a nice big check. And that's just how you go from 1 investor to 3 investors to 10 investors. It's basically just a rinse and repeat process. But again, you have to understand those key principles.
What's so interesting right now in this world right now, what I'm seeing is a lot of ecosystems that are being developed of investors, right?
Yeah.
And I thought that was really interesting. So naturally they attract, and you pay, X amount of dollars to be part of this ecosystem, but now there's a massive amount of deal flow. So as you as an investor can come and, take a look at all the deal flow. And what I find so interesting is the benefit of it, but also as the company, as someone that's listening and that's looking for investors, my question, Brad, is, what kind of green lights should they look at in regards to, okay, hey, do they want a passive investor, or do they want more of an active investor? Like, could they add value, not just revenue or like money, but also, hey, their talent, their ecosystem, their, whatever. What are the thought process or perspectives should they put into this? Not only just like the hey, can this person write a check of $500,000?
It's a great question, and it's a great thing that you brought that up. There are 3 types of capital. Okay, so when you're out there raising money, remember that there's 3 types of capital here. Number 1 is the money aspect. Well, that's the monetary capital. But if you can find an investor that has some background, or maybe made their fortune in the business you're in, they can bring basically intellectual capital. You can invite that person to be on your board of directors. Or you can ask them, hey, would you be a strategic advisor to me and my company? I mean, imagine, you're in real estate, for example, and you're fortunate enough to be introduced to somebody like Donald Trump or Sam Zell, or, any one of these big global billionaires in real estate that says, hey, man, here's a couple $100,000, go play with it. I'd want that dude on my damn advisory board. Why? Because he's made a shitload of money in real estate. And then the 3rd type of capital, Christian, is what we call relationship capital. Once you prove your abilities to an investor and they trust you, it's their network that they will hopefully open up to you. See, now you're getting referred to people that they hang out with. Now you can compress that time horizon, because you don't have to convince me that you're a badass. Somebody else has already done that for you. And so that's the 3 types of capital that I always talk about. Get the money, build the trust. If they're in a business or something that can help you, bring them on for that intellectual capital. And then once you basically get to a point where, you've proven your abilities, go back to them and say, Christian, who are you connected with that I should also be speaking to? Hopefully they'll tell you. So that's the relationship aspect.
Yeah, I want to come back to this relationship aspect, because I don't want to overstep this, because the importance of this is extreme. Just like you said, take your time, 4 conversations before you actually ask for the sale. Now, my question, you mentioned the first 2 are about the investor.
Mhm.
So, and I love what you mentioned, and I want to make sure we don't like go too quick beyond this. What kind of questions as the business owner should you be asking? And I would imagine it's something along like, hey, you know what are you looking for? What is your goal? What is your ultimate? What does that look like? Explain that to me and see how we can come along and see if there's synergy. But I'd love for you to just unpack that, kind of share that what you're thinking in regards to obviously asking the right questions to get the right information of what they are desiring.
Well, here's the important thing. At some point, you have to close. You have to realize that, you're in sales, you're selling yourself, you're selling your business, and there is a big difference between a salesperson and a closer. I find a lot of people in the sales industry, they sell flirt. They're great at talking to people, but they don't close. And when you close, you have to create what I call kind of a positive tension. The person knows you're closing them. And if you're a good closer, you'll invariably convert a lot more people. But here's the thing, when you're talking to people in the first and second meeting or the first and second call, they will physically tell you what will tempt them to move forward and physically invest. Maybe they're investing so that their money will grow so that they can buy a second home and use it as a vacation property. Maybe they're putting money aside so that they can send a kid off to college. So when I'm talking to people, I ask them, when you invest, are you looking more for income? Are you looking for growth? Or are you looking for both of them? And they'll tell you. Great. Well, how important are tax benefits to you? Are you looking for an investment that might have some tax benefits? That's important. And like I said, are you setting this money aside to do something special with it? Let them tell you. What's your time horizon? Are you looking for a short-term investment, or can you set your money aside for a longer term, maybe 5 to 7 years? And we actually have a list in our mentoring program of about 20 questions that we give to people. So it's a no-brainer. They just put it on their desk. And if they're doing a Zoom, they can just kind of look down and pretend they're taking notes. And there's the 20 questions. But, it's just a matter of building that rapport with people and really getting them to open up. Because as somebody raising money, and this is very important for everybody here, I take that very seriously. You don't just want to take anybody and everybody's money, even though you might need it. You have to realize you're a fiduciary. Once somebody invests with you, man, you have a responsibility, that person, to take that capital and grow it. So if you're asking a bunch of questions and you sense that what you're doing is unsuitable for that person based on their age or their tolerance to risk or something else that you sense, it might be wise for you to say, Christian, now that I'm getting to know you better, I really don't think this investment is for you because it is somewhat risky. You're at a point in your life that really you can't afford to risk this, and just walk away. You don't want a lawsuit. You don't want an arbitration. You don't want someone calling you every other week saying, hey, man, what's going on with my money? And I've walked away from a few opportunities before to take people's money just because I take that role very seriously. It builds trust with people. But the thing about that trust sequence is once you get to the end of the second call and you validate that that person now trusts you enough to move forward, from there, what you're essentially doing is you're teeing yourself up for success because they physically have invited you to call them back when you have something worth discussing.
Wow, such amazing insight right there. I love those questions, leading them, having that conversation, taking those proper notes, and then obviously you can use that later on. But like you said, finding the right deal for the right investor, because otherwise it causes a whole bunch of red flags in the future and
Yep.
legality and so forth. So I love to talk a little bit about structuring the deal.
Mhm.
A lot of investors always love, I see a lot of business owners always love giving out equity first, naturally, and before debt, which makes sense in its own right. But I would love to talk a little bit about kind of what that looks like. And I'm talking outside of the real estate industry, because real estate is slightly different because you can get some sort of return, et cetera, on a year to year basis. Some
Sure.
companies don't have that. There could be a possibility of rev share depending upon how you structure it. But I would love for you to just kind of explain that a little bit.
Sure, there's always equity where you're giving up, of course, part of the equity, part of the business for the upside. A lot of businesses, you can structure basically something around debt where you're just making a series of payments to an investor, maybe quarterly, maybe monthly. And then at the end of a period, 3 years, 5 years, you pay that person back, you walk away, you haven't given up any equity. And then there's, combinations of them. There's convertible preferred debt that says, look, it's going to start off looking like a loan. We're going to make a series of payments. And then based on some future, what we call a triggering event in the business, it might be valuation, might be hitting a revenue target. That'll actually convert over to some pre-agreed equity. But it starts off like debt. And then, of course, in Silicon Valley, where there's a lot of tech and there's a lot of startups, they use something over there called a SAFE agreement, which is basically an agreement for future equity that has no loan component to it. So there's all these different formulas. Hedge funds have something that they call the 2 and 20. They take a 2% fee, and then usually they take 20% of all the appreciation or growth above a certain hurdle. So when you're looking at the business you're in, you have to, number one, figure out what can the business support. Number two, how much revenue is the business generating, and does it have the ability to make payments to somebody? Maybe you're in a business that doesn't. For example, maybe you're developing real estate and you're actually constructing something right out of the ground. Well, until you get tenants in that building that are paying rent, there ain't no ability to generate cash flow. So you have to tell the investor, you're putting your money in, there's going to be a period of maybe a year and a half as we're in the construction phase. We'll then get to a certificate of occupancy, and then that spigot will slowly open up as money starts to come in, as tenants are moving into the real estate. But that's going to be a 2-year wait. So there's all these different things that really come together when you're structuring a deal. But at the end of the day, it all gets back to, you have to create something that is going to attract the interest and attention of investors. And there are people out there, typically when they get a little bit older in life, that are looking for income. So a debt type opportunity makes a lot of sense to them. When you're younger, you're naturally looking for growth. You want your money to grow. And so you obviously want some equity. And then depending on the type of business, if you're, for example, raising money to launch a product, you see this in Shark Tank all the time with Mr. Wonderful. Just give me a damn royalty. Give me $5 off of every widget you sell. So there's lots of moving parts to this, but when we sit down with entrepreneurs and we kind of have a strategy called, we discuss the business, we discuss how much they need to raise, and then we largely spend a lot of time talking about the structure to make sure that we're structuring that investment, that we're structuring that opportunity the right way, because we want the business owner to be successful raising the capital. We want the investor to be successful. We want it to be a win-win for everybody.
Well, see, that's why I think it's so fun. And I'm so glad we're talking about this, because when you actually get to the table, there's so many moving parts and a lot of creative aspects behind it, depending upon each person's situation, each investor situation. What are they desiring? Like you mentioned, tax benefits, et cetera, et cetera. And there's a lot of ways you can structure, which I think is so fun. I want to just stay here for a second. What is the most creative deal that you have done? You don't have to mention the name or any of the numbers.
Sure.
If you sign an NDA, no worries. But I would love to just maybe share like a creative deal that you structured that was like, oh, this is kind of, but it was a win-win-win situation.
Well, it's so funny because I've been doing this now for so many years and I've raised money for so many different things. I remember many years ago, there was a guy that came to me and he wanted to raise money for a catfish farm. And I'm like, man, catfish farm, like, come on. He's like, no, man, real, I want to raise money for a catfish farm. I want to raise catfish and then I want to sell the catfish to restaurants. And I'm like, okay. I mean, this was back like in the late 80s, 90s when, people were raising money for ostrich ranches and emus and all that stuff was a big craze back then. So I'm like, all right, well, how much you need to raise it? Like, I don't know, 10 million bucks. And we're going to, do it over here. And so the funny thing is I said to this guy, the best way for you to do this is to attract the attention of family offices, high net worth individuals, go to networking events, do your own networking events. And so I kid you not, this guy actually bought a hat and it was like a baseball cap. And on the side of the baseball cap were the little fins of the fish. And then there was like a little lanyard. And when you pulled it, the little flipper fins would actually flap. And he would show up at damn events, but he would get people's attention. And people would say, that's pretty cool. He's like, what do you do? I'm in the fishing business. We have a big catfish farm. We raise catfish and we sell it to restaurants. Turns out this guy's business took off. Why? Because shit, every damn restaurant needs catfish. And so we put together that deal. We gave equity to the investors. And they ended up doing really, really, really well with it. They ended up getting about a 4 to 5x return over about a 3-year period, which is, 400 or 500% on your money over 3 years. That's pretty damn good. But that was probably one of the most unusual, but today we are involved in so many really cool things, NFT projects, hedge funds, Forex, crypto, real estate, energy, even the music and the entertainment space, people raising money for feature films, for musical soundtracks, albums, all sound studios. So, the position that we're in, basically coaching and mentoring entrepreneurs, is we get in front of so many really cool, amazing things. Some of them make sense. Some of them you kind of scratch your head, but then when you really look at it and you look at the revenue model, you're like, if you can make that work, man, it's a home run. But here's the thing, and this is a real important thing for all your listeners to really zero in on, because at the end of the day, this is what separates the people that have success raising capital and the people that don't. I actually learned this from Kevin Harrington on Shark Tank, who spoke at my event last year. He said, Brad, a lot of people come onto the show, as we all know. Some people get deals and some people don't. The people that don't, it's not necessarily it's a bad deal. It's not necessarily that they're a bad person or that they're uneducated. It comes down to just one thing. And that one thing is, you have to convince me as an entrepreneur or as an investor that you can execute. That's the key word. You have to be able to execute on the strategy or the business that you're in. Because if you can't execute, why in the world would I throw my money at you? And, I think that's a big message for people, because a lot of people that are probably listening to your show, Christian, are what? They're solopreneurs. They're just one person building a business. If you go to any big investor and say, hey, invest with me, and they look at you and you're just a solopreneur, do you think they sense the ability of you to execute? Probably not. But when you say, hey, I'd like to introduce you to my CPA, he's going to be the guy keeping all the books and records. And at the end of the year, he's going to send you your tax reporting information. And over here is my buddy, Bob. Bob's a partner in a law firm. He's going to make sure that we dot our I's and cross our T's. And over here, I got Steve. Steve has 20 years of experience doing this. He's one of my strategic advisors. You see, now you build that power team. Now you're much more believable. Now the investor says, okay, I think that you and your team can definitely execute on that. What's the next step in us moving forward together? And so we talk a lot about building that power team as it relates to raising capital, because that's so very important in that person ultimately having success and picking up a check.
And I'm glad we're talking about this, because again, that was going to be one of my questions in regards to, like, what does an investor, when they're looking at, because there's certain things that when I'm looking at a deal, there are certain questions that I know to ask, because of course I want to look at the 5-year kind of financials and kind of diving into that and so forth, et cetera. So as a business owner that's listening to this, that, that's running at a 7-figure, they want to do some raise capital, et cetera. And they're sitting there going, okay, well, we may need to get our books adjusted because we don't have them all dialed in, right? Because you don't want to start getting this the cart before the horse. You don't want to start asking for investing, and then all of a sudden you lose out on amazing opportunities. So you want to make sure you have your ducks in a row. What does that look like in regards to someone? And like you mentioned as well, if we know that they're looking, hey, can I execute? Well, what does that mean? Like, hey, last 5 years, we had a 15, 20, 30% year over year growth. Hey, that shows we've got some execution and we can, right? So that's what I'm just curious, because it's like execution. What does that translate into regarding the business flow?
Well, here's the good thing. Number one is, you don't need audited financials unless you're dealing with non-accredited investors. And so I basically advise people, don't deal with non-accredited investors, because the standards that the SEC holds you to are much higher, and it's much more expensive to do that. So just make sure everybody you're raising money is from accredited. But you can have a bookkeeper, you can use an accountant to keep the books and records. But at the end of the day, when you're doing what we call due diligence, that's analyzing the person, analyzing the deal, there's definitely things you want to look for. Do they have a track record? Do they have a clue? Do they have any prior performance? But more importantly, do they have the infrastructure, or can they bring the infrastructure together for important things? Reporting at the end of the year, so that that person knows what their proportionate share of income and losses are. What I call quarterly newsletter. You just don't want to take someone's money and then say, see ya. You want to be able to provide transparency. So you need to start thinking about things like investor relations. What does that look like? Well, it's being transparent. It's maybe sending a quarterly newsletter to all your investors, or inviting them to join you maybe on a quarterly webinar where you're just updating them on the progress of the business. You're telling them what the heck you're doing, because you don't want to take someone's money and then essentially go into a black hole where that person's chasing you down for information. So the more transparent you become in that investor relations role, the greater the potential for you to raise capital. Why? Because now people are going to trust you. Again, they're going to open up their network and they're going to introduce you to people that they're connected with, because they see that you're the real deal. You're delivering on what it was you said you were going to do. And those are all important elements. A lot of people that try to raise capital forget that once that person actually gives you a check, that's where the real work begins. It's easy to get investors. Sometimes people think it's next to impossible, but it's not, because there are investors around us every day. You just have to really learn how to attract them, know what to say to them, be able to close them, have a good story. But the real work starts after you actually raise the capital, because that's where basically you have to now think about the other side of the fence, which is the reporting, the transparency, the investor relations, and more importantly, hopefully delivering solid returns for people.
I love this. I love this. And I think that's so important, because I do see where, and I see this even in the smaller caliber, where you maybe an insurance agency and you only reach out to your current clients when you need a renewal for that thing. And it's like, man, and someone I had on the podcast, and he was talking about the power of relationships, just kind of what we're talking about. And it's like in every aspect, just different channels. So I really appreciate you kind of foot stomping on that. And again, even when you have them, you need to always be engaging, building out a system, building out a process. So correct me if I'm wrong, they, with the accredited investors, kind of what we're talking about specifically, they're not going to get into too much in the weeds of your financials. That should be more of that conversation with the CPA, and the CPA would be talking, correct? And then they would basically give them a report and say, hey, yes, Brad, this is a good opportunity, etc.
Well, I mean, you don't want to bring your CPA into the presentation. That's not necessary, but somewhere in your offering memorandum, you should either have projections. Maybe you show some financials as to how the business is performing, what it's doing, if the business has actually been around for a while. But a lot of times, you're raising money on a startup. You really don't have any financials. All you have is projections, and you're able to say, hey, here's our projections based on the number of customers that we anticipate getting, or just based on our knowledge of the industry. So it really depends largely, Christian, where you are in that business cycle. Are you a startup, or are you basically in the early growth stage? What type of an investor are you looking for? Are you looking for an angel investor? Are you looking for maybe a private equity firm to come in because now you're more late stage and you want to scale to that next level? Because when it comes to investors, there are different types of investors. There's the high net worth, there's family offices, there's institutional money out there. These are the insurance companies, the trusts, the pensions, the sovereign wealth funds. So, you really need to figure out, number one, how much money do I need? You never want to raise too much, or again, you never want to raise too little, because that's an important secret as it relates to success. You don't want to, have a business where you need $1 million and you only end up raising 300, because now you've made promises to people and you have to go back perhaps at a later date and raise more. But then you have to go back to the investors to raise that more and say, well, I told you that I was going to give you 25%, but you have to give some of that up because we now need more capital. And so that's what we call dilutive. You're diluting your prior investor's position. That's a bad thing. So, I always tell entrepreneurs, sit down, really figure out what your vision is, what your needs are, so that if you're raising capital, you can raise capital efficiently. Now, if you do need more, that's okay. You can always raise a B round or a second round of capital, but do so maybe where you have now another share of class, so that, the earlier investors get rewarded, maybe with a higher return, or maybe they're preferred and they actually come before the new investors in terms of the returns that are generated. So, there's all these things, like you said earlier, that come into consideration that we help people with, because at the end of the day, when you're raising money, you want to do it efficiently. You want to do it, it's never quick, But again, you don't want to be out there trying to raise capital where somebody asks you 9 months into your capital raise, how's it coming along? Well, we're still slugging it out. If you're trying to raise 5 million bucks and they say, how much have you raised? 300. Nobody's going to give you money then, because then you have a false impression that something is wrong with the deal. And so I tell people, start small, learn how to walk before you run, because you can always raise larger amounts of money once you have an understanding of how to do this. But, if you come to me and say, yeah, we want to raise $50 million. And I'm like, great. Do you have any experience raising money? No, never done it before. It's going to be a long slug, man. But if you say, hey, our goal is to be raising $50 million 3 years from now, great. Let's raise 5 successfully. Then let's scale that and do 10 to 15 successfully. Then maybe you launch a fund and you do a $25 million fund, but you've already got a base of investors that know you. And then after you do that, now you can come out with a $50 million fund, maybe in 3 or 4 years. See, now there's a natural progression. That's much more realistic than just coming out of the gate saying, hey, we're going to raise 50 million bucks.
Now, let me ask you in regards to, and you were saying this, I've heard some where they're asking, $250,000 for 30%, depending upon where they're at in EBITDA. And then some individuals are asking for 5-10 million, and they're at 15% equity, right? And I always find it very interesting what the owner and the owner is willing to give for, and what they're asking as well.
Sure.
So I'm always just curious, is there kind of a baseline in regards to hey, when you're at this annual income and you're giving this kind of equity, this is kind of what you expect, or is it really just all dependent? I'm just curious.
Well, it really depends. And here's the thing, certain industries trade at different multiples. And so, there are some, as we say, sexier businesses where, they trade at a higher multiple of EBITDA. But again, it really comes down to the negotiation, how much perceived risk there is associated with the investment, because any investor wants an above average risk adjusted rate of return. And if you're in a business or you're doing something that is a startup, there's a hell of a lot more risk than me investing with somebody that's been up and running for a few years, where they got a 7-8 figure business and they got the wind in their sails. So naturally, where there's more perceived risk, there needs to be greater reward. And that's why a lot of times when you're raising money in a startup, you got to give up a good piece of the equity, because there is a lot of risk in that startup venture. You certainly don't want to give up too much, but at the end of the day, you want people to open their checkbook. So, again, those are all things that you need to sit down and give some thought to. But again, it comes down to risk reward and what that investor really is looking for if they're taking on a lot of risk. But if you've been in business for 5 years and business is successful and you're going out into the marketplace trying to raise kind of $3 million or whatever to take that business now on a journey to a whole nother level, now there's not really as much risk. Maybe now you can approach investors. You don't even have to give up any equity. You're just like, look, man, we just want to borrow money. We'll just pay you some interest over the next 3 years. And then boom, we'll do something. We'll, refinance, or we'll have some type of an event in the business's growth, and we'll be able to give you all your principal back. Or again, it will convert to equity, but based on certain triggers that take place in the business. We go out and have the business valued, or go out and look at our revenues. And once we hit those benchmarks, you'll be rewarded. But that's really the key piece here. It's risk reward. What investors want in exchange for the risk that they perceive they're actually taking with you.
So when these investors, and because I have my own way of thinking, when I'm always asking, okay, when I give you X amount of dollars, okay, what are you going to do with it? Right? Because that's what I'm always intrigued with. And a lot of times that's in their kind of the slide deck that they give me, what they're looking for. Now, what's interesting to me is there's certain red flags, like, okay, hey, if they're putting all their money into hiring, I'm not so sure about this. If they're putting into infrastructures like a software, okay, cool, I can see the return on that potentially, right? And then as well as sales and marketing, like some of those are green flags for me. But I'm just curious from your experience, Brad, and I probably depends on real estate. I mean, like industry, obviously, if you're talking about real estate, it's a whole nother thing. And then obviously other industries and so forth. But I'd love to get your experience, what you have noticed, what investors that really oh, you're putting X amount of dollars in this. Okay, cool. I know kind of because I've been in this industry for X amount of years. I know that this is going to be a good investment. And these owners, business people, they are on point because they know exactly what to do with my money. So I just love to talk a little bit about that, Brad.
Yeah, no, absolutely. It's a great question. When you have a private placement memorandum where you're raising capital or even in an executive summary, you should have a chart in there that we usually refer to as use of proceeds. This is how we're going to use the money. So if we're raising, for example, $5 million, here's kind of the use of proceeds. Some of it's going to go into marketing. Some of it might go into advertising. Some of it might go into hiring, training. Some of it basically might go into, the launch of a new product. So when we talk about how the capital is being used, what it really comes down to and what I'm really trying to assess at the end of the day is, do these people that are raising money even quote have a clue? Do they know their business? Do they know where they're going to spend that money? And more importantly, how they're going to spend it? And one key question I always ask is, how long will the capital you're raising last? Meaning, what's your burn rate? How quickly are you going through capital right now? Because, if they tell me that, hey, we're burning through $200,000 a month, great. And you're trying to raise $2.5 million, that tells me that you basically have about 10 months before that money's gone. So is that really going to be enough capital? Maybe we should have a conversation about you raising 5 million if you're spending 250 a month. So all of those questions are the right things to be asking as an entrepreneur. But again, it also begs the question, how much do you really need for the business? And do you have a clue as to where you're going to spend that money to get the biggest bang for the buck? Certainly every business needs marketing. Every business should be advertising. Every business, of course, needs people to scale. You can't build a 7, 8 figure business. Well, you can, but it's really hard until you build a team of people around you. So, let's talk about how that money's being spent. And that's why a use of proceeds chart is so very important for a business owner when they're going out there trying to raise capital. So that entrepreneur, that investor can actually see how their money's actually going to be invested. And more importantly, how that money, where it's invested, is going to generate a return on investment for that person.
Do you, when you're looking at deals and you've talked to investors, do they tend to gravitate like, way one, kind of use of funds more so than the other, or vice versa? Or is it all just relative depending upon the deal and the business and the industry?
Yeah, it really just depends on the industry. It depends on the space they're in. It depends on really kind of where they are in the growth of the business. If you're starting out, you need people. If you've got a more mature business, you've already got the team. Now you need to spend more in marketing or advertising. So, it's really all over the place. There's no quote secret recipe as it relates to the use of proceeds. It really just largely is dependent on where you are in the growth of the business. If you're coming out of the box, you might be spending more of the money on salaries or, putting together an office to bring a team together. If you have an existing business where you have the team in place, now you just need it more for marketing and advertising. So again, it largely is just determined on kind of where you are in the business's growth and really what that business needs. Certainly real estate is kind of an anomaly because you need money to make money in real estate. It doesn't matter whether you're doing single family and you're rehabbing, doesn't matter whether you're trying to raise capital, take down a multifamily property. Real estate is just one of those damn businesses, unfortunately, where you need money to make money.
Do I would imagine, because like for example, I partner with a private equity firm and I help them raise some capital a little bit.
Mhm.
And what's interesting is they have a whole structure. They only work with companies that are in the SaaS world that are like 1.5 million EBITDA and more, et cetera. So they have a very kind of like filtered process of the deal flow, which is nice. And then obviously I work with investors that are very familiar with this industry, et cetera, et cetera. But our flow really is our exit strategy when we're taking on a company,
Yeah.
majority ownership. It's like, hey, within 5 years, we have growth projections, but our
Mhm.
exit strategy is IPO or something else, right?
Right.
And so I'm curious, from your experience, And again, like real estate is a different game because you can get a nice return year over year,
Mhm.
depending upon how it's structured. But obviously, other businesses definitely when you take an equity position, again,
Sure.
how you structure it, a lot of times it's just pure equity, and then you'll hold that money, and you
Right.
may not have access to that capital for a while, because et cetera, et cetera. So I'm just curious, what have you seen in this regard?
It's a great question because I've worked in the private equity space for private equity firms raising capital, and they talk about something in their business model. It's called the hockey stick, right? Where you go in, you basically buy a position into an existing business, and a lot of times, what those private equity firms will do is they'll take on debt. So they're going to borrow money, but they're going to put that money, quote, back into the business. So it's kind of like that Nike swoop, right? You buy in, you take on debt, so you're actually putting more debt on the books, but then you get this exponential growth because of the manner in which that debt or that capital was infused and injected into the business. And then, of course, they hope to exit by selling to a much larger private equity firm, or doing something like an IPO or something like that. But those are all really, really great, good questions. At the end of the day, again, it comes back to the business. And with real estate, of course, it's a little bit differently. But when you look at how you're generating returns for investors in real estate, you have, of course, tenants that pay rent. And then, of course, hopefully the real estate appreciates, you have upside appreciation. One of the other great aspects of real estate that a lot of people overlook are the considerable tax benefits. You get depreciation, you can write off all the, quote, capital expenditures, all of those things. You can't do that in a lot of other businesses. So, when you look at how you're generating that return for prospective investors, you need to look basically at all the angles. When I'm raising money, for example, for real estate, I talk about the tax benefits because that is huge. If you're distributing money on a quarterly or monthly basis and you tell an investor, look, we use cost segregation, which is a technique of dramatically accelerating the depreciation on this property so that it accelerates and covers a much larger percentage of the income that's coming to you. We're going to be able to shelter 85% of the income in the first couple of years. That's huge to an investor, because we talk about something called the pre-tax equivalent yield. Now, that might be over the head of a lot of people that are on this call, but for people in real estate, that's a term that you should definitely be talking about. So, when it comes to basically raising money and having conversations with prospective investors, it's always great to find people that have some sense of experience in the industry that you're in so that you don't have to, quote, educate them. Because if you have to educate a new investor on the business you're in, more than likely they're not the right investor for you.
This is some golden stuff, man. And you're exactly right. There's so much that goes into it. And that's why I
Mhm.
wanted to have you on because, one, I'm seeing a lot of people as definitely as I'm podcasting, but throughout, as I'm having conversation, a lot of people are always looking to raise capital, et cetera, et cetera. And they're always talking about, like you mentioned, where, hey, my goal is 1 million. The reality is you really don't need that much once you actually look at your structure. And then as well as, oh, well, where are you at? I've only raised 50, 100K. It's like, oh, well, you got a long journey. And then, like you mentioned, the lack of credibility all of a sudden starts to play in the current investors. So it's very interesting. My question then to you is, and we were talking a little bit about this because I wanted to talk a little bit about your Capital Con and some exciting news about some activities you got going on. But when you're looking at a company, and like you mentioned, a lot of people just throw up a number, say, this is kind of what I need to raise. I think there's a lot of science that goes into it, and I'd love for you to just talk a little bit about it, Brad.
Yeah, I mean, a lot of people just pull a number out of thin air. And, you're going to be very unlikely to successfully raise capital if you just randomly pull a number out of thin air. Because most investors will ask you, can I see your projections? How did you come up with the amount of money you need? How is that money going to be spent? And so if you just randomly, quote, pull a number out of thin air, well, I'd like to raise $5 million, you really don't have a clue. That kind of tells me again that that person, quote, does not have a clue relative to the business they're in. I've been in real estate for many years, and so I can literally walk into almost any building and within a range of a couple $1,000s, know exactly what it will cost to renovate and rehab, because I know what construction costs are. So if I'm working with a real estate person, this is just an example, and they're going to be rehabbing a property, and they just randomly throw a number out there, I'll be able to basically see through the bullshit, for lack of a better word, because they have no clue again. But if I'm looking at that same opportunity, and in my mind, I've calculated what that number is, and they're, within a couple $1,000s one way or another, I then know, okay, they have a clue. They know what it's going to cost. Same thing with, a bigger deal. If it's a big multifamily transaction, as they're raising capital, there's the equity that they need to, quote, take down the deal. But then have they given thought to some of the other things that you need to be considerate of? Like, do they have reserves? Are you setting aside reserves so that, God forbid, you have a problem with the HVAC, or you have a plumbing issue, or you have a roof leak? You don't want to have to go back to your investors. So again, it comes back to, do they have a clue as it relates to the business they're in? And more importantly, how they're going to be spending the capital. Because all those things are so very important, and most people that, are investors are not just looking at, quote, the one deal that they're having a conversation with you. They're looking at, quote, multiple deals. Let's face it, rich people, man, they're approached all the time. I can't tell you how many times I'm pitched. So I have a lot of alternative places to, quote, put my money. Now, naturally, I want to put it in the best place. And so that's why I do spend time really getting to know people, really having those deep conversations to make sure that if I'm going to park my money with somebody, there's trust, the deal makes sense. I see what the return potentials are. I know what the time horizon is on that. But more importantly, I know how that person is going to execute on that strategy, kind of what their secret sauce is for me, that's going to actually make that return much more realistic in my eyes. Because at the end of the day, that's really what it all comes down to.
Wow, this is such an insight, man. Brad, I really appreciate you having to go through the ups and downs of doing all the deals and all this stuff so that you can bring immense value to my audience, but so many others. And I can just tell years upon years upon years of experience in this, and having those conversations, having those dialogues, and just knowing, like you mentioned, going into some sort of real estate deal, you already know what is, what's needed, what's already processed, what's already doing, because you've done it 1,000 times. It's the same thing when you're looking at with consulting and coaching with so many people doing capital raising, because it's like, hey, I know what the investor is going to ask. I know how to build a relationship. I know what this is looking for. I know how to have the right, contract, the conversation, et cetera, et cetera. So I love to talk a little bit about Capital Con. You got a cool event here happening in November, which is really exciting. Some really top-notch speakers and knowledge professionals. And then also I'd love to talk about the boot camp, but let's talk a little bit about Capital Con happening here in November.
Absolutely. Well, we do a big event every year. We appropriately call it Capital Con, and we're positioning that globally. We'll start doing them in other countries next year. But Capital Con really is an event that we host for people to actually come to one location and hear from literally some of the best and brightest minds when it comes to using other people's money, when it comes to learning how to attract, raise, and close capital. Last year we had Shark Tank's Kevin Harrington, for example, as one of our guest speakers. Well, if you're going to learn how to pitch anything, who better to learn from than one of the original hosts of the TV show Shark Tank? So he was there talking about how you pitch a deal, how you position your product, how you approach investors, what you say to investors. Last year we had financial literacy expert Sharon Lechter. She's been the financial literacy expert to 2 US presidents. She co-wrote the book Rich Dad Poor Dad with Kiyosaki, but she also, of course, is well known for annotating Napoleon Hill's work, Outwitting the Devil. She was there. So what I do is I bring together a team of basically what I call A power players. These are the speakers that are going to be there at the event. This year we have Dave Seymour, A&E reality hit TV show called Flipping Boston. Today, he's a big multifamily investor, but guy's a TV celebrity. He'll be there. On the mindset side, I have literally one of the world's greatest endurance athletes. This guy is a freak of nature. Everybody, of course, knows David Goggins. This guy makes David Goggins look like a wussy. This guy, Darren Miller's in the Guinness Book of World Records. He was the first person in the history of mankind to complete all 7 swims of what they call the Ocean Seven. These are the 7 longest channels around the world. So the English Channel, the Cook Strait, the Tsugaru Channel, and you don't get to wear a wetsuit in this frigid water. All you get are your Speedos, your goggles, and a swim cap. He was the first person ever to complete all 7 swims on the first attempt. And in the history of the world, there's only been about 20 some odd people that have ever done this. Once he crossed that off his bucket list, he's now doing 50 and 100-mile endurance runs. So he's going to talk about mindset in terms of how he does this. And so, over the course of 2 days at CapitalCon, you're going to get the coaching and training and mentoring from some major thought leaders on how to raise capital, how to use it, how to invest it, how to create wealth, how to create the right mindset to have success. It's the 4th and 5th of November. We got 4 different levels of tickets based on just where you want to sit in the audience, how much proximity you want to get with some of the speakers. And then we also have sponsorship opportunities. For the right business, it definitely makes sense to consider being a sponsor at this, to position yourself front and center in front of all the people that are going to be there. We give you a table, we give you time on stage to talk about your business, and we drive traffic through that exhibit hall to all of our exhibiting sponsors so that the people that are there, the attendees, basically get to know you, get to understand how you might be able to add value to their business. So that's our big event. And we're so excited. This is our 2nd year. And we basically want to grow this to the largest event of its kind. Let's face it, there's a lot of real estate REIs and a lot of real estate events. We want to take that just to a whole new level.
I love it, man. That is awesome. And guys, that is actually bradblazer.com is where you can actually, get into that. You got the boot camp, the Capital Con, his books, his podcast, everything right there. So make sure I'll put that link in the description. So make sure you stop. And it's to engage. And the biggest thing is for those that are listening, we're sitting there going, okay, you know what? I'm hearing this. I know I need help, but right now we're not focused on that. That's not top of mind. It's better to do it now and start building that foundation. So then when you are ready to turn the dial on and turn that faucet, you're ready, you're prepared, you're rocking and rolling. Like I mentioned, you don't want to all of a sudden have a conversation with an investor, a potential investor, and you don't have your shit together. And so that's the reason why I think having that conversation, reaching out, bradblazer.com, and going to that event. And it's also networking, it's engaging, and obviously, like you mentioned, destroying those limiting beliefs and saying, hey, you know what, I can obviously accomplish this and really scale and really crank this in from people that have already done it numerous other times. So that's awesome. And also, Brad, I know you're mentioning obviously your boot camp, which for those that can't go to the CapitalCon, which I think people should, boot camp, that's really cool as well. You got some live training. Explain that a little bit for us.
So we do 8 boot camps a year. We try to keep them pretty small, pretty private, typically 25, 30, 35 entrepreneurs. We don't want to have a huge mass of people. And that's where we really break down everything about raising capital from A to Z. So think about, a coaching program that typically spans a couple of months, 60 hours of content delivered through a fire hose. It's kind of what I call the crash course of really learning how to do this. And we teach everything from launching a fund, putting together the perfect pitch deck, knowing how to attract investors, knowing what to say to investors. We cover the 4-step blueprint, all the what I call key fundamental principles. And that's 8 boot camps we do a year. But again, you hit the nail on the head, Christian, with something that you said earlier. The purpose of going to events is, number one, of course, to get motivated, inspired, and learn, but it's also the networking. I find attending events to be priceless because you're only one connection away sometimes from meeting somebody that can dramatically change your life. I mean, putting you on a whole new trajectory, changing your business. One person can do that. And here's something that many people overlook. When you hire a coach, somebody like myself that has played at the highest levels, that share the stages with people like Floyd Mayweather, Grant Cardone's partner, Brandon Dawson, Jesse Itzler, Sharon Lecter, Coach Michael Bird. I mean, I could go on and on, John Maxwell. You overlook the fact that that person can now connect you with any one of those people, right? And so I'll share a story with you. I had a coaching student by the name of Tanny, and she had a ticketing platform where they were selling tickets, much like Eventbrite. But because she was a collegiate athlete, when she built this platform, her and her partner approached Major League Sports. And so they were selling tickets to baseball games, basketball games. One of their clients was the Summer Olympics, and all this ticketing was going through her platform called Friendly Sky. And when COVID came out, I never will forget this. She called me and she was in tears, like, oh my God, we're having to give refunds. All these big sporting events are being canceled. I'm going to have to file for bankruptcy. I'm so nervous. Why? Because everything was being canceled. It was COVID. And I said, look, that's not the way a entrepreneur thinks. We will adapt. We'll figure this out. What she didn't realize, Christian, is the day before I was on the phone with Matthew Knowles. Now, Matthew Knowles used to be the CEO of a company called Music World Entertainment. Can you guess who his daughter might be? That's right, it's Beyonce's father. He handled the careers of people like Chaka Khan, Kool and the Gang. And I was asking, what's going on in the music world? Like all the concerts are probably being shut down. Oh God, Beyonce's like beside herself. You don't know they're giving rain checks, but yeah. And I'm like, well, how are they keeping the bands together? He's like, it's a huge stress for any major entertainer. They can't do concerts. I'm like, well, don't most of these people like have studios at their house? He's like, well, yeah. I'm like, well, why don't they just sell tickets and do a live stream concert to their fan base? They probably got thousands of fans on Facebook. Just announce, hey, we're doing a virtual stream concert, sell tickets, and then, sell posters and t-shirts. You mail them out. He's like, oh, it's a brilliant idea. 2 days later, guess who I was introducing my student to? She just about fell out of her seat when she realized she was talking to Beyonce's dad. And within 3 weeks, her client list was Winona Judd, Sheryl Crow, Asleep at the Wheel, two-time Grammy artist, Billy Dorsey Jr. And she's just like, and I said, boom, through me, one connection, I changed your life. And so today, when you go to her platform, she's selling tickets to musical venues, still sports. But you see, that's the power of working with somebody as a coach. You don't realize that that person can connect you to their network if they feel that that can help you and your business. And so, that's really the reason that any entrepreneur, any business owner should look at getting a coach in their life, because a lot of times that coach has access to people that can dramatically really just take your business to a whole nother level, not just on the capital side, the raising of money, but also more importantly on that networking and on that connection side as well.
Oh man, that story gave me chills, and I believe that 100%. I've heard so many things like that, and I love that. And I think it's the serendipity, but also like what you value more is that relationship, right? You probably didn't get paid, you didn't probably do it, but it was just more of that conversation. Like, hey, I can network, and obviously you, Brad, you had that significance in life, and I just think that's so awesome, man. And having people like you that are able to make those connections, just because you got a big heart, and I can tell that right away. Brad, I really appreciate just the immense value that you brought today. Just having this amazing conversation. And like I mentioned, just you had to go through your own ups and downs, and being able to now have an amazing conference and maybe amazing network and amazing opportunity and amazing knowledge, like you said, coaching as well, and coaching some high caliber individuals. I know I mentioned bradblazer.com. Is there anywhere else that they can reach out to you and just consume your content, Brad?
I'll tell you, man, if you Google me, I show up everywhere. I'm on Instagram. Just be aware of some fake accounts out there. You get the haters, you get the naysayers always in life, and people want to be you. So if you're going to go find me on Instagram, it is just Brad Blazer. There's no misspellings, there's no S's or anything. It's just at, or the little whatever that symbol is, Brad Blazer. There's no E's in my last name, so it's BLAZ, like zebra, AR. But I'm on LinkedIn, hell, I'm on Facebook, I'm on Instagram. Of course, we got the website. We got tons of podcast episodes all over Google, all over Amazon. I mean, not Amazon, all over YouTube. So just Google me and, shoot me an email, shoot me a DM, shoot me anything and I'll respond back. We got a team of people here as well as virtual. So we're pretty good at getting back with people. And more importantly, if you're an entrepreneur listening to Christian's show, if you need access to capital, you want to learn how to raise money, let's schedule a free strategy call. No obligation. We'll talk about your business. We'll talk about your capital needs. We'll talk about what you want to do. And if you're a good fit, great. If not, we'll tell you and we'll send you on your way. But as I say, There's nothing lost in getting on a quick 30-minute Zoom with somebody that has the ability to teach you how to raise money. Our number one student year to date, Dustin, over $100 million for his business came out of a meeting he had with the family office right after he attended one of our boot camps. But we got people like Nicholas, probably raised $10 million year to date, basically using that capital to go out and buy and aggregate businesses, largely in e-commerce. So, we got people raising a couple 100,000 all the way up to tens, hundreds of millions of dollars. It really just depends on what your needs are. And then once we talk about your needs, I can figure out the audience and, more importantly, the type of investors you need to be getting in front of.
Awesome, guys. And those links will be in the description below. And again, Brad, I just appreciate your immense value. And make sure, guys, when you're listening to this, it's all about taking action. It's all about going out there and networking, engaging, going to CapitalCon, engaging with Brad, having that conversation. If you're sitting there and have like an idea or a thought or a question, hey, reach out to Brad. And again, Brad, I just appreciate your immense value today. Now, before I let you go fully, I always love to ask my guests, is there any last words of wisdom that you'd like to share with our audience?
Yeah, the one thing that I will share is you got to do it, and that's the big thing. It comes down to anything in life, but more importantly, you got to be intentional. That is a word that I picked up on after sharing the stage with John Maxwell. Now, John Maxwell arguably is one of the most, noted authors on the planet. I mean, the guy's New York Times bestseller, and he's such a cool, low-key dude. But he said, look, success comes to those that are intentional in life. The problem a lot of people have is you sit back and you take whatever life just throws at you. You live life on the defensive. And so you show up at work and you just take whatever life throws your way. If you want success, you need to sit down and figure out what you want. And then you have to be intentional in pursuing it. Break down the goals so that you know daily, weekly, monthly, what you need to be working on. It's just like a pilot that wants to make that plane go up. He's got to be intentional to pull back on that joystick. It's like a race car driver that wants to go faster. He's got to be intentional to push down on that accelerator. So the big thing, man, about anything is be intentional in what you want to do. More importantly, find the time for the things that are important in life. I mean, I get all the excuses. Oh, I just don't have the time, or there's not enough hours in the day. Bullshit on that, as Matt McConaughey would say. Wake up an hour earlier for the things that are important to you. I was up at 4:30 this morning, got a 5-mile run, and while most people were still asleep. Why? Because that shit's important to me. So that's it, man. Money just does not show up in a wheelbarrow at your front door. If you really want to learn how to raise capital, you got to be intentional, but you got to go through the motions. You got to make the calls. You got to have the meetings. You got to have the follow-up systems in place. And the great thing about it is if you're willing to do it, man, you can dramatically transform your life and have more abundance, have more money, and more importantly, have more wealth and have more fun.
And that is my friend, the $2 billion guy, Sir Brad Blazer. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.